How NVIDIA will destroy the U.S. economy in the next 3 months. Part 1. The tech titan that became too powerful. The United States economy stands on a fragile edge. For decades, Wall Street's lifeblood has been innovation, from oil to steel, then to silicon. But in 2025, one company has grown so dominant, so influential, that its rise now threatens to unbalance the entire financial ecosystem. That company is NVIDIA. In just 3 years, NVIDIA has transformed from a niche graphics card manufacturer into the most powerful company in the world, commanding the artificial intelligence boom, dominating the semiconductor supply chain, and becoming the primary driver of the U.S. stock market's gains. But beneath the glitter of record-breaking profits and trillion-dollar valuations lies a silent danger, one that could trigger an economic collapse within months. Let's break it down step by step. The unstoppable growth machine, NVIDIA's stock performance since 2022 has been nothing short of historic. Fueled by the AI revolution, the company's market capitalization soared past $3 trillion, briefly overtaking even Apple and Microsoft. Every hedge fund, pension fund, and retail investor piled into the stock, treating NVIDIA as the gold of the digital age. But this level of concentration has created a massive vulnerability, the NVIDIA bubble. In simple terms, too much of America's financial stability now depends on the fate of a single company. More than 30% of the S&P 500's 2025 growth has been driven by NVIDIA alone. The Nasdaq's rally, mostly NVIDIA, the tech ETFs that millions of Americans hold in their retirement accounts, heavily weighted toward NVIDIA. When one company becomes this powerful, it ceases to be just a business. It becomes a systemic risk. And like every bubble in history, this one will eventually burst. The hidden AI overdependence, the foundation of NVIDIA's meteoric rise, is its monopoly over AI hardware, specifically the GPU chips that power large language models and data centers. Tech giants like Microsoft, Google, and Meta rely almost exclusively on NVIDIA's H100 and A100 chips. Every new AI product from ChatGPT to self-driving cars is built on NVIDIA's architecture. But here's the problem. This monopoly has made the entire AI industry dangerously fragile. If NVIDIA faces a supply chain disruption, a legal investigation, or a market correction, it could paralyze the entire AI sector overnight. And since AI investments are now one of the core growth drivers of the U.S. economy, that shock would ripple across every major index. Even worse, the valuation of AI companies is based on speculative expectations, not sustainable revenue. If NVIDIA's chip prices fall or its order backlog shrinks, the illusion of endless AI growth could shatter instantly. Investors would flee, not just NVIDIA, but the entire AI market. The stock market's dangerous dependency. Think of NVIDIA as the beating heart of America's current stock boom. If that heart skips a beat, the entire system suffers cardiac arrest. In the last 12 months, analysts have noticed something alarming. When NVIDIA's stock rises, the S&P 500 rises. When NVIDIA's stock dips, the entire market follows. This correlation is historically unprecedented. In financial terms, NVIDIA has become a systemically important asset. The Federal Reserve doesn't talk about it publicly, but internally, economists know. If NVIDIA crashes, it could trigger a chain reaction, margin calls, ETF liquidations, and algorithmic trading spirals that wipe out trillions in market value within days. Just as the collapse of Lehman Brothers in 2008 triggered a global financial crisis, a sudden collapse of NVIDIA's stock could set off the next one. Only this time, it won't come from banks or real estate. It will come from technology itself. The illusion of endless growth. Every investor today believes the same story. AI will revolutionize the world, and NVIDIA will profit from it forever. But markets never move in straight lines. Just as the dot-com bubble of 2000 was built on overhyped dreams of the internet, the AI bubble of 2025 is built on blind faith in NVIDIA. The company's revenue growth, while impressive, is slowing down. Competition from AMD, Intel, and even new Chinese AI chipmakers is intensifying. And global demand for GPUs is beginning to plateau as major companies complete their initial AI infrastructure build-outs. Once demand cools and orders slow, Wall Street will realize the numbers don't justify the valuation. When that realization hits, the correction will be swift and brutal. Part 1 Summary. NVIDIA has become too powerful for the system it inhabits. It now represents not just innovation but imbalance, a single point of failure for the U.S. economy. The AI gold rush has inflated its stock to unsustainable levels, creating a bubble that's bigger, faster, and more dangerous than most people realize. In the next part, we'll explore how NVIDIA's market dominance is distorting the Federal Reserve's policies, inflating asset prices, and setting up the conditions for a 2025-style financial shock. How NVIDIA will destroy the U.S. economy in the next 3 months. Part 2. The Fed's AI addiction and the coming policy trap. In the United States, The Federal Reserve has always been the invisible hand that keeps the financial system stable. But lately, even the Fed seems to have fallen under the spell of the AI boom, and more specifically, under NVIDIA's influence. What was once a central bank that reacted to real economic signals has now become dangerously entangled with speculative tech growth. And that addiction could soon become America's undoing. The Fed's artificial optimism over the past year. The Fed has repeatedly cited technological productivity as a reason for optimism about the U.S. economy. In simple terms, they believe AI, and by extension, companies like NVIDIA will make businesses more efficient, raise profits, and sustain growth without inflation. But this assumption is built on paper profits, not actual output. When Wall Street analysts and tech executives parade AI as a cure-all, the Fed sees rising stock prices and interprets them as signs of a healthy economy. In reality, those stock gains are speculative bubbles, fueled by hype, not hard productivity data. And as NVIDIA's market value skyrockets, the Fed mistakes financial euphoria for economic strength. This illusion has trapped policymakers. If NVIDIA's price collapses, it won't just erase market wealth, it will shatter the Fed's confidence in the AI-driven recovery narrative they've been selling to the public. The policy feedback loop. Here's the dangerous cycle at play. NVIDIA's stock rises. The market rallies, boosting investor sentiment. The Fed sees confidence and loosens its tone. Easy money fuels more speculation in NVIDIA and AI assets. The cycle repeats. This is known in macroeconomics as a policy feedback loop, a situation where central bank optimism is based on the very bubbles their policies are inflating. It's not the first time it's happened. In the early 2000s, Alan Greenspan's Fed did the same thing during the dot-com mania. They saw rising tech valuations as proof of real productivity, until the bubble burst in 2000 and wiped out trillions. Today, the Fed is repeating the same mistake, only on a larger and riskier scale. The AI economy is far more leveraged, interconnected, and global than the internet was in 2000. How NVIDIA distorts monetary policy. Because NVIDIA's stock and AI-related assets have driven the majority of market gains, the Fed is now afraid to crash the bubble. Every time inflation ticks up or rates need adjustment, policymakers hesitate, worried that tightening conditions could send NVIDIA's stock tumbling. This hesitation has paralyzed monetary policy. Think about it. If one company's market cap has become so large that raising interest rates could trigger a nationwide slough, the central bank is no longer in control. The corporation is. That's what economists call asset capture. It's when a single asset, industry, or company becomes so critical to market stability that policymakers start designing their decisions around it. This is exactly what's happening with NVIDIA right now. The dangerous role of leverage. Wall Street's obsession with NVIDIA hasn't just inflated stock prices, it has also created enormous leverage. Institutional investors are using borrowed money to buy NVIDIA shares and AI-related ETFs, betting that prices will keep rising forever. This leverage is invisible to most people, but it's everywhere in the system. When margin debt is high and a single stock dominates indexes, even a small decline can trigger margin calls and forced liquidations. That's how the 1987 and 2008 crashes spiraled out of control. Leverage amplified small shocks into full-blown crises. Now imagine NVIDIA's stock dropping 20% in a week. AI ETFs would crater. Hedge funds would dump other assets to cover losses. The Nasdaq would collapse. The S&P 500 would fall sharply. And within days, retail investors would panic sell. It wouldn't just be a tech correction, it would be a systemic event. The AI mirage versus real economy. The strangest part of this story is how disconnected NVIDIA's success is from the real U.S. economy. Despite record profits for chip makers, most American households are struggling. Wages aren't keeping up with inflation. Housing is unaffordable. Debt levels are exploding. Yet Wall Street celebrates NVIDIA's earnings as proof that the AI revolution is saving the economy. But the average American gains nothing from these record profits. They don't own high-end GPUs or data centers. They own jobs that could soon be replaced by AI, the very technology that NVIDIA enables. This is the cruel paradox. The more NVIDIA grows, the more inequality widens. AI companies get richer, stockholders celebrate, but millions of workers lose relevance. Eventually, consumer demand weakens, and that weakness circles back to corporate profits. That's how bubbles implode from within. Foreign dependence and geopolitical risk. Another overlooked factor is NVIDIA's dependence on Taiwan. Semiconductor manufacturing company TSMC, which produces the vast majority of NVIDIA's advanced chips. If geopolitical tensions between the US and China escalate, or if any disruption hits TSMC, NVIDIA's entire production line could collapse. That would send shockwaves through global markets. In short, America's most overvalued company depends on one of the most vulnerable regions on Earth. That's not just risky, it's reckless. The next 3 months, the perfect policy storm now. Combine these forces: A Federal Reserve trapped by inflated market optimism, a leveraged Wall Street addicted to AI speculation, a real economy weakening under debt and inflation, a single company holding the market together. If NVIDIA's next earnings report disappoints, or if the AI hype cycle cools, the shock will reverberate instantly. Traders will dump tech stocks, funds will de-risk, and within 3 months, the illusion of stability could collapse. The Fed, already cornered by its own optimism, will be powerless to stop it. Part 2. Summary. The Federal Reserve has tied its credibility to an illusion, the idea that AI, led by NVIDIA, guarantees permanent growth. But when central banks begin reacting to stock prices instead of fundamentals, financial discipline disappears. The result is a fragile economy propped up by one company's speculative rise. In the next section, we'll go even deeper, exploring how Wall Street's NVIDIA obsession is creating a debt-fueled chain reaction that could ignite the worst market crash since 2008. How NVIDIA will destroy the U.S. economy in the next 3 months. Part 3. Wall Street's NVIDIA addiction and the chain reaction of collapse. NVIDIA's dominance isn't just a story of innovation, it's a story of financial dependency. Over the past 2 years, Wall Street has turned NVIDIA into the ultimate speculative asset, the everything stock that drives every major index, fund, and investor sentiment. But that same dependency now threatens to implode the U.S. financial system from the inside out. This is how addiction destroys empires, not all at once, but through overconfidence, leverage, and denial. The NVIDIA obsession on Wall Street, at the core of today's market mania, lies one dangerous truth. Everyone from hedge funds to pension managers is betting on NVIDIA. Institutional investors have poured hundreds of billions into AI-themed, exchange-traded funds, ETFs, and tech-heavy portfolios. Nearly every major fund, including BlackRock, Vanguard, and Fidelity, holds massive NVIDIA positions. Even passive index funds that track the S&P 500 are disproportionately dependent on NVIDIA's performance. This means that the moment NVIDIA stumbles, every portfolio in America takes a hit. It's no longer a single stock, it's a national financial dependency. The feedback bubble. How every trade feeds itself. The mechanism fueling this bubble is simple yet deadly: passive investment and algorithmic trading. When NVIDIA's stock price rises, index funds automatically buy more of it to maintain weighting. That buying pushes the price higher. Then, momentum trading algorithms detect the uptrend and pile in, driving prices even higher. Retail traders see the rise and rush to buy, believing it's unstoppable. This self-reinforcing cycle creates an illusion of infinite demand. But it's not based on real fundamentals, it's based on machines buying machines. And when the cycle reverses, the same automation that inflated prices will accelerate the collapse. The very algorithms that pushed NVIDIA to the sky will, in panic, drive it straight into the ground. The rise of the AI leverage bubble. Behind closed doors, major investment banks have been issuing complex derivatives tied to NVIDIA's stock options, swaps, and structured AI-linked notes. These products amplify exposure and profit potential, but they also multiply risk. It's eerily similar to the mortgage-backed securities of 2008. Back then, the financial system built mountains of leverage on a single assumption: housing prices never fall. Today, the assumption is just as fragile: NVIDIA's stock will never crash. The numbers are staggering. Some estimates suggest that for every $1 in NVIDIA's market cap, there are $20 in synthetic bets tied to its price movement. That's leverage on leverage, a house of cards built on optimism and algorithms. If NVIDIA's value drops even modestly, these derivative positions could trigger margin calls across the system. And because many of them are interconnected, one fund's failure could cascade into others, exactly as it happened in 2008. How AI mania distorts corporate America. Wall Street's obsession with NVIDIA isn't just financial, it's psychological. Every major CEO feels pressured to show that their company is investing in AI. This has led to a corporate spending frenzy. Billions of dollars are being poured into data centers, GPU clusters, and AI research with little or no immediate return. Companies are taking on debt to buy NVIDIA hardware, not because it guarantees results, but because investors demand it. This is malinvestment, capital flowing into projects that exist to sustain a narrative, not to produce real value. And malinvestment always ends the same way, with collapse. When the expected profits don't materialize, those debts will become toxic. And corporations will start cutting spending, firing employees, and offloading assets. That's when the AI miracle turns into an economic nightmare. The everything bubble effect. NVIDIA's meteoric rise has inflated not just tech stocks, but everything around them. The surge in market capitalization has created a wealth illusion. Investors feel richer, so they spend more, pushing consumer prices up. That forces the Fed to tighten policy, which in turn strains credit markets. This loop between asset inflation and monetary tightening is a recipe for instability. The U.S. economy is now so leveraged to stock performance that a correction in NVIDIA could instantly freeze. liquidity across multiple sectors. Imagine it like this. If NVIDIA loses 40% of its value, trillions in collateral tied to tech equities could evaporate. Banks would pull back lending. Corporate bonds would sell off. The ripple effect would hit everything from housing to small business loans. A single corporate stumble could snowball into a full-blown recession. Retail investors. The final wave, perhaps the most tragic part of the story, is that millions of small investors have been lured into this mania at the very top. They see headlines about NVIDIA's trillion-dollar valuation and believe they're witnessing history, not realizing they're the last buyers in a bubble. Just like the dot-com boom of 2000 or the crypto surge of 2021. Retail traders are flooding into the market through platforms like Robinhood and eToro, buying fractional shares of NVIDIA at all-time highs. When the crash comes, they'll be the ones left holding the bag. History doesn't repeat, but it rhymes perfectly. The three-stage collapse pattern. Financial historians can already outline the path of collapse. Stage 1. Reality shock. NVIDIA reports slower growth, weaker demand, or new competition. Analysts revise expectations downward, and the stock dips 10 to 15%. Stage 2. Liquidity crunch. Margin calls hit leveraged funds. Derivatives unwind. AI ETFs face heavy redemptions. The Nasdaq falls sharply. Stage 3. Contagion. The selling spreads to broader markets. Credit tightens. Consumer confidence plunges. Within weeks, trillions in paper wealth vanish. This process can unfold in less than 3 months, given today's algorithmic speed and high interconnectivity. The AI bubble will not deflate slowly, it will burst instantly. The hidden trigger events. Several potential flashpoints could start the chain reaction. A disappointing NVIDIA earnings report. A ban or restriction on chip exports to China. A geopolitical shock affecting Taiwan or supply chains. A credit downgrade of a major AI-heavy ETF or fund. A massive short squeeze gone wrong among hedge funds. Any one of these could ignite panic, and once the first domino falls, there will be no circuit breaker strong enough to stop the collapse. Part 3 Summary. Wall Street's addiction to NVIDIA has transformed a single company into a systemic threat. Through leverage, derivatives, and passive investment loops, the entire financial system is now entangled with one stock's fate. If NVIDIA falters, the chain reaction will be swift, wiping out trillions, freezing credit, and plunging the U.S. into economic chaos. In Part 4, we'll explore how this collapse will ripple beyond Wall Street into jobs, housing, and even the U.S. dollar itself, creating the conditions for hyperinflation and the breakdown of confidence in the American economy. How NVIDIA will destroy the U.S. economy in the next 3 months. Part 4. When the chip crashes. How NVIDIA's fall could ignite U.S. hyperinflation. When one company props up an entire market, its fall shakes every corner of the economy. If NVIDIA's valuation implodes, it won't just crush investor portfolios, it will detonate a far larger bomb hidden beneath America's financial system: debt and currency distortion. This is how a tech crash can spill over into real-world inflation and social panic. The wealth-to-debt collapse. Every boom in U.S. history has been financed by debt. And the AI mania is no different. Corporations have borrowed trillions to buy back shares and invest in AI transformation. Consumers, watching markets hit record highs, have borrowed more to credit cards, auto loans, mortgages, believing that rising assets make them safer. When NVIDIA's bubble bursts, those perceived assets vanish overnight. The result is a wealth shock. Households that once felt secure suddenly cut spending. Corporations slash budgets. Tax revenues drop just as government spending spikes to contain unemployment. The Federal Reserve's only response, historically, is to print money and reinflate liquidity, but that's exactly what turns a deflationary crash into monetary inflation. The dollar's confidence crisis. NVIDIA's collapse won't directly print dollars, but it will destroy confidence in them. Here's why. The global demand for U.S. assets is what keeps the dollar strong. Foreign investors buy U.S. stocks, bonds, and tech shares to park their wealth in safe, high-growth instruments. If America's most prized company implodes and drags markets with it, that faith evaporates. Foreign capital will begin to flow out of U.S. markets into gold, commodities, and even rival currencies like the Chinese yuan. As foreign demand for the dollar falls, its exchange rate weakens. Imports from oil to electronics suddenly cost far more in domestic terms. Prices rise across the board. That's how a stock market crash morphs into consumer price inflation. The Federal Reserve's impossible choice. The Fed will face a nightmare dilemma. Tighten policy to defend the dollar and crush inflation. That would worsen the crash and bankrupt leveraged institutions. Loosen policy to stabilize markets. That would flood the system with new dollars and ignite runaway prices. History shows central banks almost always choose the second path: printing, buying, and promising. That temporary fix calms markets but destroys long-term trust in money. Once people and foreign governments believe the Fed will always bail out Wall Street, the dollar becomes a melting ice cube. How inflation turns to hyperinflation. Hyperinflation doesn't start with price tags, it starts with beliefs. If the public loses faith that the dollar will hold value tomorrow, they rush to spend it today. Retailers raise prices hourly, suppliers hoard goods, and wages chase costs in a vicious spiral. Imagine the sequence. NVIDIA crash wipes out $3 trillion in market wealth. Fed injects liquidity to stop contagion. Dollar weakens. Bond yields soar. Imports jump 30 to 40% in cost within months. Companies raise prices. Workers demand pay hikes. Government prints more for stimulus. Inflation explodes into double digits then beyond. 3 months of panic can rewrite an entire currency system. The domino impact on real-world sectors. 1. Tech employment. Mass layoffs hit software engineers, data scientists, and chip designers as funding evaporates. Startups relying on AI hype vanish. 2. Housing. Mortgage rates surge as bond markets wobble. Real estate values tumble, but monthly payments soar. Foreclosures rise. 3. Energy and food. A weak dollar makes oil and grain imports more expensive. Fuel and grocery prices explode. 4. Public debt. Washington's interest payments on its $35 trillion debt balloon, forcing either drastic austerity or more printing. Either choice erodes living standards. 5. Social tension. As savings vanish and essentials rise in cost, protests erupt. Political polarization deepens. Populist leaders promise radical fixes, none sustainable. The psychological phase of collapse. Markets don't just run on numbers, they run on narratives. When the story changes from AI will save us to AI destroyed us, collective psychology flips. Investors, executives, and citizens start hoarding tangible goods, gold, land, even basic food stocks. The velocity of money accelerates, trust in paper evaporates. That psychological shift is what economists fear most. It's unpredictable, irreversible, and self-reinforcing. Once belief in stability dies, recovery takes years, sometimes generations. Why 3 months matters. Financial contagion moves faster now than ever before. Algorithms trade in microseconds. Information travels instantly. If NVIDIA disappoints, its crash could erase trillions in hours. Within 1 quarter, the knock-on effects, currency, weakness, layoffs, inflation, and policy panic could fully materialize. That's why analysts call it a compressed crisis. What took 18 months in 2008 could now unfold between January and March 2026. Part 4. Summary. A collapse in NVIDIA's valuation wouldn't just rattle Wall Street, it could shatter confidence in the dollar itself. Fed bailouts would flood markets with liquidity, turning a market crash into a currency crisis. Prices would soar, wages lag, and inflation could spiral into hyperinflation within months. In Part 5, we'll conclude this series by examining who benefits, who suffers, and what ordinary Americans can do to prepare for a post-NVIDIA economy. How NVIDIA will destroy the U.S. economy in the next 3 months. Part 5. The Aftershock. Surviving the post-NVIDIA America, the end of a financial bubble is never the end of the story. When NVIDIA's dominance collapses and the AI mania unravels, the world won't simply return to normal, it will awaken to a new reality. The question isn't whether the crash will come, but how Americans will survive the aftermath. The shock that freezes the system. Within weeks of NVIDIA's downfall, every major market index would convulse. Trillions in paper wealth would vanish from retirement funds and 401ks. Banks would scramble to meet liquidity demands, cutting credit lines to small businesses and freezing lending. The U.S. government would announce temporary stabilization measures, just as it did in 2008, only this time, the public wouldn't buy the illusion. Confidence would collapse faster than credit. Consumers would stop spending, businesses would halt hiring, and unemployment would surge. The economy would seize like an engine out of oil. This is the first stage of economic paralysis, the moment when panic turns from Wall Street to Main Street. Winners and losers of the collapse. Not everyone loses in a crash. The rules simply change. History shows that in every economic reset, a few key groups emerge stronger. The losers. Retail investors. Millions of ordinary Americans would watch their savings vanish as the market plummets. Tech employees. The AI industry's mass layoffs would ripple across Silicon Valley and beyond. Middle-class families. Rising inflation, falling wages, and job insecurity would destroy their purchasing power. Small businesses starved of credit and crushed by inflation. Many would shut down permanently. The winners. Hard asset holders. Those with gold, silver, land, or commodities would preserve real value as paper assets implode. Energy producers. Oil and resource companies gain pricing power when currency weakens. Foreign competitors. Nations with strong manufacturing bases, especially in Asia, would absorb global capital, fleeing U.S. instability. Debt-free individuals. Anyone without liabilities would navigate the storm more easily than those chained to interest payments. The great redistribution of wealth that follows a crash always favors those who hold tangible value over digital promises. The AI mirage shatters when the AI bubble bursts. Investors and policymakers will confront a hard truth. Most of the revolutionary companies built around AI were never profitable, and many never will be. The realization will crush venture capital funding. Startups once worth billions on PowerPoint slides will collapse overnight. Data center construction will halt. GPU orders will evaporate, and demand for NVIDIA chips will implode. That's how one company's fall cascades into a full-scale industrial contraction. Without the illusion of endless technological growth, the U.S. economy will have to rebuild itself around real productivity, not speculative innovation. Government response: print, spend, and control. When the crisis peaks, Washington will do what it always does: print more money and expand control. Expect massive stimulus bills, emergency subsidies, and new digital currency proposals under the banner of stability. A central bank digital dollar, CBDC, might be introduced to track spending and distribute aid instantly. While marketed as a modern solution, it would mark the start of a surveillance-based economy, where every transaction can be monitored and controlled. The government would argue it's necessary to prevent another NVIDIA-style collapse, but in truth, it would centralize financial power even further. Freedom would erode as quickly as savings. The global power shift, the U.S. economy's implosion, wouldn't happen in isolation. Foreign investors would rush out of American assets, accelerating the global shift already underway. China, India, and Russia would seize the opportunity to position themselves as the new technological and manufacturing anchors of the world economy. Nations long dependent on the dollar would begin forming regional trade blocs using local currencies. Petrodollar contracts would unwind. Oil and commodity pricing would diversify away from U.S. control. The very thing that made America dominant technological innovation would become the cause of its decline. The AI century might end before it truly begins. The path to survival in times of collapse. Survival isn't about predicting the future, it's about positioning for uncertainty. Here's what financial historians, economists, and pragmatic investors often recommend when facing systemic risk: diversify into tangible assets. Gold, silver, farmland, and real estate hold intrinsic value when paper markets fail. Reduce exposure to debt. Inflation punishes borrowers with variable rates and collapsing collateral. Build emergency liquidity. In a credit freeze, cash, even devalued, buys time and flexibility. Prioritize real skills. In post-bubble economies, practical professions, energy, food, repair, logistics outperform speculative careers. Stay mobile and informed. Economic crises move geographically. Flexibility and accurate information are survival tools. The most resilient individuals aren't the richest, they're the most adaptable. The cultural reckoning: every great economic collapse comes with a cultural reckoning. When the AI illusion fades, society will ask the same question it asked after every financial disaster: how did we let greed become our god? The 2020s promised enlightenment through artificial intelligence, yet it delivered obsession, speculation, and inequality. NVIDIA's collapse will force America to confront the darker truth behind its progress. Innovation without discipline destroys more than it creates. From the ashes, a humbler, more balanced form of capitalism might emerge, one focused not on algorithms and hype, but on human value. The final outlook: the next 3 months could redefine the modern financial order. NVIDIA's dominance has made the U.S. economy fragile, overleveraged, and dangerously dependent on speculative belief. A single disappointment, a weak quarter, a geopolitical flare-up, or a tightening cycle gone wrong could ignite the final stage of collapse. The sequence is already set in motion. Overvaluation gives correction, correction gives panic, panic gives monetary flood gives inflation, inflation gives currency crisis. From there, the fall of a chip company becomes the fall of a currency. Epilogue: lessons from the edge. History doesn't repeat, but it does whisper warnings. The railroads of the 1800s, the dot-coms of the 1990s, the housing boom of the 2000s all followed the same pattern: overconfidence, overleverage, and collapse. NVIDIA's meteoric rise is the latest, and perhaps most dangerous, chapter of that story. If America fails to learn from it, the price will not just be measured in dollars, but in trust, stability, and identity. The coming crash won't be the end of innovation, but the end of illusion. And from that reckoning, a new age, one grounded in reality rather than hype, might finally begin.